So yesterday, Friday, December 7th, 2018, I recorded a great interview with Brent Johnson. I thought the audio quality was going to turn out great. In the past, over the last couple months, whenever there has been issues, Zencastr tech support has been able to solve them. I was listening to about 11 or 12 minutes of the audio, and most of it was very good. And then there were stretches where the two tracks, there was just combining and jabbling, and a lot of the audio got mangled together in stretches. So the whole thing isn't bad. I'm going to release the interview, but this is what happens when I try to upgrade to new technology. And unfortunately, Brent Johnson, there's a lot of tech requirements in order for Zencastr to work properly. As in, you have to have a brand new computer with a good processor, basically a brand new operating system. You have to use Google Chrome, all these other things. And apparently Brent Johnson did not have that. So I will present the interview to you guys. I'm sorry, it's not going to be perfect. There's a lot of audio that is overlapping, unfortunately. It was not the whole interview, but it is what it is. This is what's happening with a free podcast where I just don't have the resources to have the right equipment and have the right audio editor clean things up, because the Zencastr tech support has very expensive audio editing software that can clean things up, and my long-time audio editor, part-time, pay-per-job, he doesn't have the software to clean this. Okay, well, without further ado, here's the Brent Johnson interview from yesterday, Friday, December 7th. Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I believe he was on in March, and he had recently released back in March his video about his Milkshake Theory. He is the CEO of Santiago Capital. He's also in the Austrians and Finance group with me. Brent Johnson, thank you for joining me again.
Thanks for having me. Always happy to come on and talk to you and your listeners.
So for listeners who didn't see your Milkshake Theory video in March, can you please summarize it?
The Milkshake Theory kind of goes back 10 years, and it goes back to after the financial crisis. All the central banks of the world got together. They took out their monetary syringes and they injected an enormous amount of liquidity into the system. Dollars, yen, euros, pounds, et cetera, et cetera. And for a long time, they kind of did that in coordination with each other. But then about 4 years ago now, the Fed kind of went their own way and stopped injecting liquidity. And in fact, they stuck a straw down in there. And by lifting up interest rates in the United States, they started sucking the liquidity from around the world up into the United States. And that's allowed us to look relatively better than the rest of the world. And I think it allows us to continue to raise interest rates. And as it starves the rest of the world for the dollars that they need to operate, and we can go into why they need dollars to operate in a little bit. But as it stands now, they need dollars to operate. And as those dollars get sucked back into the domestic U.S. economy, it starves the rest of the world of those dollars. And it creates this vicious loop outside the United States, and it creates this kind of benign loop inside the United States where I think it's going to allow Powell to keep raising rates slowly. And I think that pulls, it kind of goes back to this area that it pulls more capital in and allows them to continue raising slowly. And so on a relative basis, I think U.S. asset prices go up, foreign asset prices go down. And in a couple of years from now, it'll all end very, very badly. But I think that's kind of how it plays out between now and then.
Looking at a financial history perspective, does this kind of remind you of the couple years prior to the October 1929 crash? Because back then, a lot of the other major economies and stock markets were in a recession or depression. There had been stock market crashes and depressions in other countries, and a lot of capital was coming into the U.S. for a couple years prior to October 1929. And there was some fundamental reasons for this, because there was like innovation with radio and for refrigerators and other appliances, automobiles. So yeah, does that remind you of the couple years prior to October 1929?
There's been talking about how they think we're kind of in a repeat of the 30s. I kind of think that we're in a repeat of the late 20s. But we, in the early 20s, we had a big financial crash. And then we had the Fed came in and lowered rates for a while, and it led to the booming 20s, or the roaring 20s, I think it was called. Pretty similar to what we've had over the last 7 or 8 years. And then, if you were, somebody who kind of paid attention to what was going on back in 1926 or 1927, you'd say, holy cow. I mean, they've just stimulated the heck out of this market. It's probably a good time to buy bonds and get out of the equity market, because the stock market had doubled over the previous, 6 or 7 years. But from 1926 to 1929, interest rates doubled and the stock market doubled. And over those same 2 or 3 years, treasuries fell 30%. And a lot of it had to do with capital that was flowing back into the United States. Not only that, but the yield curve, which everybody says is a deflationary indicator and a sure sign of recession, inverted, and it stayed inverted for 2 to 3 years. So I see that as a very apropos comparison to what we have going on now. And again, this is all going to end very badly. A yield curve inversion is certainly not a good sign. But what a lot of people don't talk about is that they will talk about how a yield curve almost always leads to a recession. But what they don't talk about, they only tell like half the truth. Because while it does almost always lead to a recession, it doesn't usually happen for a year, or about 18 to 24 months after the curve inverts. And they don't usually tell you that in that 18 to 24 months before the recession hits, equity prices typically go up. So, again, it all ends very, very badly. When I make my arguments for, dollars flowing back into the U.S. and U.S. asset prices, including U.S. equities going higher, it's not because things are good. It's because things are bad. Things are really bad. It's just that they're worse everywhere else, and it squeezes liquidity into the United States, and that squeeze of liquidity pushes asset prices higher. So, this isn't a Pollyannish view that the Fed has saved us, and we're at exploding growth, and everything's going to be fine. I actually think it's going to end up really badly, but I think before we get to the really big downturn, I think equity prices and U.S. asset prices are going higher.
And if I could add to your points there, with your milkshake theory, these other central banks, whether it's the People's Bank of China, the Bank of Japan, the European Central Bank, the Swiss National Bank, they've created many trillions of dollars in excess liquidity. In China, there's tons of credit. We can talk about that later in the interview, get your opinion on China. And it seems that, in the past, there could have been hyperinflation in some of those economies, but instead that monetary inflation and all that credit excess, a lot of it was directed towards just asset prices in the US. So that would fit that, instead of the hyperinflation in the real economy, as some Austrian school economists would have been predicting, instead the beneficiary, and I don't know if the Fed intentionally wanted this or they just got lucky, and they were able to reduce their balance sheet while this was happening. That excess monetary inflation went into asset prices. And, that's good for the government in the U.S. because that means more capital gains taxes.
I've talked about this with some people before. And again, I don't think this was the plan of the Fed. I don't think they set out to say, hey, let's all start pushing down interest rates and then we'll start raising ours before everybody else and we'll steal everybody else's liquidity. I think it's probably more dumb luck than anything. I don't give any of these guys too much credit. But one thing that I do like to point out is that most people I talk to, I shouldn't say most people I talk to, many people I talk to will challenge my theory. And listen, it's worthy to challenge this theory. This is not exactly it hasn't happened a lot before, right? And so those who take pot shots at it, they have some good arguments of why it might be wrong. But the typical argument is that the Fed is out of control. They've tied themselves to this monetary policy that's unsustainable. They've painted themselves into a corner. And I always say, yes, you're absolutely right. You're arguing the wrong thing because I agree with you on that. But what many of the people that challenge my theory fail to do is to look at the other central banks and the other countries with the same critical lens that they look at the United States. Europe is an absolute disaster. I don't care what anybody says. It is a disaster of monumental proportions. Asia is in a lot of trouble. China is in a lot of trouble. Japan is in a lot of trouble. Australia is in an incredible amount of trouble. So, if you look at the policies of those central banks and you look at the policies that those politicians have put into place, it's not like there's some shining examples of what should be done and the U.S. is here just out here looking like a bunch of idiots. They've all done things that are going to come back to haunt us, all of us. And to somehow single out the United States as the only offender here, I think is to not look at the world as a whole. And so, anybody who thinks that I'm a Fed apologist or thinks I'm on the Fed side, it's not that way at all. And to be very clear, I'm a very big critic of central banking and central bankers in general. But that said, I don't think that this is going to play out the way that everybody thinks it's going to play out. I can name off the top of my head 10 or 12 well-known people who think that we're due for a recession, that equities are going lower, and that we're going to have a huge equity crash. And listen, that can happen. I can be wrong, and that can happen. But if we get the downturn now, it is going to be the most predicted market crash in history. It's going to be the most predicted recession in history. And the certainty with which I hear so many people saying that it's going to happen now reminds me very much of the certainty with which many people, myself included, said QE was going to be a highly inflationary and lead to hyperinflation, which it absolutely did not. I think that people have been tied to this narrative of stocks going to crash for so long they just can't let it go. Now, it doesn't mean that stocks aren't going to crash at some time, and it doesn't mean that some of the arguments that they put forth are not totally valid arguments. But getting the arguments and the timing down perfectly does not always work out, and in fact, it usually does not work out. So I'm open to the idea that we can move into a recession here. My argument, though, is that we're just not ready to have it yet. I can be wrong, but we've seen a lot of volatility over the last 2 months. And a lot of people will ask me, doesn't this negate your theory? And I keep saying, no, it doesn't. My milkshake, the joke I make is that if there's not volatility, it's just a glass of milk. You need to shake it up to make it a shake, right? And despite all the volatility, despite all the angst, et cetera, the market's flat for the year. Maybe it's down 1% or something after today, 2% after today, but it's basically flat for the year. Yet most of the markets in Europe are down double digits. Most of the markets in Asia are down double digits. I don't think there's a commodity market that's up for the year. There's not a single currency in the world that's up versus the dollar. Even gold is down versus the dollar this year. So on a relative basis, the U.S. looks pretty good. And a lot of people will say, yes, but on an absolute basis, gold will outperform, and that's where you should be. And listen, I'm a huge proponent of gold. Everybody should have gold. Again, it's a wrong argument. But for the rest of the assets, it is a relative game. Whether you like fiat currency or whether you hate fiat currency, the fact is we live in a fiat currency world. And until everybody agrees that we should go to a gold standard, it's going to be a fiat currency world. And so it is a relative game. And when you're investing relative to something else. And so if the U.S. looks better relative to everything else, then I want to be in the U.S. And again, this is not saying that we've done a great job. It isn't to say that we are going to have this grand booming economy. It just means we're better off here than somewhere else. And so that's kind of how I see it.
Yeah, I see problems everywhere. I mean, you didn't mention emerging markets too. They're another group that has problems with the dollar, especially we're at 96.71 on the dollar index when we're recording this interview on Friday, December 12th. The dollar rally continues.
Yeah, no,
I'll ask you if you think the dollar rally is going to continue, but I'll just get my point real quick. If the dollar rally continues, goes
China,
to
but,
99, 100, 102, God forbid, over 102 on the dollar index, that's going to cause immense problems.
Are two of the biggest offenders of what I call the they tried to do this very clever trade about 10 years ago as well, 5 to 10 years ago, where they saw that the Fed was creating all this liquidity and that they were attempting to devalue the dollar, and so they thought, what, we have trouble raising capital in our own currency. Let's raise capital in dollars. It'll be more accepted by the market. We'll get a lower rate by doing it, and then as the dollar depreciates over the coming years, we'll pay it off with our appreciating currency, and we'll make money both sides of the deal. And so they issued tons and tons of dollar debt, Argentina and Turkey being the two of the biggest ones. But the problem is that the dollar didn't keep depreciating, and as their economies turned down, they weren't making as much money, and now they have to pay back this huge dollar debt that is getting bigger as the dollar appreciates. And so they've gotten into this situation where this clever trade that they put on is becoming a nightmare. And as a result of these dollar funding pressures, the Turkish stock market is down about 50% for the year. Argentina is about the same. Both of their currencies are off 40 to 50%. And emerging markets in general, over the next 3 years, have $200 billion that's coming due in principal form. So they're due, and so it's not like they have to roll that over the next 2 years. And $200 billion doesn't sound like a lot living in the U.S. when we were doing QE, which was 30, 40, 50 billion a month. It's just 3 or 4 months of QE. But to the emerging markets, $200 billion is an incredible amount of money, even in good times, and let alone in bad times. And you add on top of it that the dollar is appreciating, it makes it even worse. And then you think about that they were having these huge dollar pressures this year when the dollar is still below 100. It's still below it where it was 2 years ago. And so while it's up 5% this year, it's still down from where it was 2 years ago. And so, like you said earlier, if the dollar gets back to 100, 102, 105, 110, which I think is very possible, it just makes not only those problems for Turkey and Argentina worse, but it makes problems for everybody worse. It makes problems for people in the Middle East worse. It makes problems for others in Asia. It makes problems for China worse. It makes problems for Australia worse. And it's because the world is still on a dollar system. And, until a new system comes along, and I hear all the time about there's going to be this new system, maybe there will be. But until it gets here, it is still a dollar world. And as dollars are being sucked up into the United States, supplies of dollars is falling, demand for dollars is still there. You've got a supply demand imbalance, and that's a pretty good formula for price to rise.
And the other thing, Brent, to add to your points there about the dollar too is,
Absolutely.
And this is probably the triple whammy, and you've heard this with governments like Malaysia with their Petronas, their national oil company, you have the drop in commodity prices. So a lot of these emerging markets were reliant on higher commodity prices to make the cash flow to pay off the dollar-denominated debt. So not only has the dollar strengthened, you have
the U.S. is no longer a huge importer of energy. And, to a certain extent, we're energy sufficient or self-sufficient at this point. For years and years and years, we were exporting our dollars because we were buying oil with it. Now we're not exporting our dollars in exchange for oil. And the dollars that we are exchanging in exchange for oil, it's come down 30% in the last month. So from that perspective, there's not as much dollars going out to the rest of the world. So, I just feel like we have this perfect storm of dollar supply versus dollar demand that is going to push the dollar much, much higher. And I honestly think that the whole world, all asset classes, all markets are really one big dollar trade right now. The dollar is going to be the determining factor in all the markets, in my opinion, over the next year to 2 years.
Now, how do you think President Trump feels about this? Because if the Federal Reserve is hiking rates, they want to give themselves maybe more ammunition for the next crisis. They don't mind a stronger dollar because
he's a real estate guy.
Economy. Although recently the Federal Reserve just put out a report, talking about if interest rates continue to rise, there could be corporate bond defaults. But don't you think, though, that Trump wants a weaker dollar? So what do you think is going to be his reaction if the dollar
continues to strengthen? Central banks around the world have held interest rates low for years in order to stimulate demand. So I do think that he would prefer to have a weaker dollar. Now, that said, I don't think that he is as set on having a weaker dollar as many other people think that he is. And in fact, I think that should he ever figure out that a strong dollar is his biggest weapon, the rest of the world better watch out. Because if he figures out that he can use the strong dollar as a weapon to bring other countries to do what he wants them to do, he will yield that. He will be more than happy, I think, to use a strong dollar to his advantage. Now, I think at the end of the day, what Donald Trump cares about is his ratings in the stock market, right? If the stock market's going up, I don't care. I don't think he cares what interest rates are doing. As long as his equities keep going up and he can point to a growing stock market, I don't think he cares whether interest rates are at 2.5% or 3.5% or 4%. And I actually believe that if as interest rates rise and it pulls more capital into the U.S., I think that will be initially supportive of stock prices. So I'm not somebody who thinks that just because interest rates are rising, we're necessarily going to have a recession or a stock market crash. So it's kind of a long way of answering your question. I think if he had his choice, I think he would like a weaker dollar and lower interest rates. But I don't know that he's going to get it. And just because he wants it, I don't necessarily think he's going to get it. And to the Fed as well as I don't necessarily think the Fed wants to keep raising rates either. But if the market keeps taking rates higher, the Fed just following along. For the last 3 years, I don't think the Fed has been leading the market. I think the market's been leading the Fed, and it's allowed the Fed to keep raising. At some point, the monetary authorities and the powers that be lose control and markets take over again. And I kind of think we're at that point. So while, public policy or monetary policy and central bank policy and politicians can influence markets, and it'll no doubt cause some volatility and some swings here and there, I think we're getting back to a point where, we're at the end of this debt super cycle. At some point, the jig is up. And I just think when the jig is up, I don't think it's necessarily bad for stocks, if that makes sense.
So you think that the stock market can continue to go up despite the strong dollar and despite if the Fed hikes rates, that there could be more General Electrics out there? Because, I don't know the timing of these things. I haven't looked at a ton of different, these blue chip stocks, and I'm using air quotes. I did a live stream show on this talking about how the ratings agencies have again rubber stamped the next crisis. I don't know the exact timing on this, but they kept AAA credit ratings for companies like GE way too long, allowed them to borrow way too much money without downgrading their credit. That is another crisis. So you think then that the stock market will not really care about this until there's actually a lot more default, similar to General Electric?
Will be a relative refuge in a currency market storm that is coming. I think we will get capital flows from around the world that will flow into the dollar. I don't think it will just sit in cash. I think it will go into, some of it will go into equities. I think, as you point out, that as interest rates rise, some of these companies in the United States that are over indebted will have trouble. To be clear, I don't think we're having this runaway growth where we're going to have this stock market, which is booming because everything is great. I think it's possible that as things slow, but as we get these capital flows and people start to realize that we are having this currency crisis around the world, it's eventually going to come back to the US. We have this credit crisis around the world that's eventually going to come back to the US, but it's going to hit these other countries first. And as sovereign debt starts to come under pressure, corporate debt and sovereign debt starts to come under pressure, people will not want to hold sovereign debt. So in my mind, there's bubbles in real estate, there's bubbles in equities, but the biggest bubble is sovereign debt. And when you want to get out of one bubble and you need to go somewhere else, there's only so many places you can go. Now, everybody tells me they're going to go to gold. Well, you know what? Some of it might go to gold, but the whole world is not going to sell all their sovereign debt and buy gold. It's just not going to happen that way. So even if a lot of it goes to gold, if some of that comes to another asset class, I think equities will be one of the asset classes that it flows to. And I think U.S. equities in particular will be one that it flows to. Now, maybe they'll avoid the GEs. Maybe they'll avoid some of the other highly indebted companies. But the companies that are out there that do have, a better balance sheet or a better product or a better growth potential, they will be in very high demand because there's just not that many of them out there. And I think that, again, as capital gets squeezed into that very small number of companies, it pushes them higher. I don't know that it's necessarily going to reverse, but I don't think it's going to lead to a wholesale collapse in the equity market, because I don't think that everybody's going to sell all their stocks and go buy bonds. I think there's just as big a bubble.
So if I could summarize what you said, you think that the stock market's going to shrug off bad news if there's more future General Electrics, if some of the FANG stocks have problems. I mean, even this week, some of the retail stocks that were going up almost parabolic the last 12 to 18 months have started to crack. So you think that that's going to reverse then?
Frightening. It is not going to be easy. Even the people that kind of, I don't think it's going to be easy. Even if I turn out to be right, which there's no guarantee that I'm right, but let's pretend for a second that I am. It's not going to be easy for me. It's going to be scary as heck sometimes, right? Like the last 2 or 3 weeks, they've been very, very volatile. You can't ignore it. But I still think we look better on a relative basis. There's a lot of people that I speak to say, you know what, I'm just gonna check out. I'm gonna hold cash. I'm gonna hold some gold, and I'm gonna come back in a couple of years. That's fine. If that's your strategy, and you don't mind sitting on the sideline, then that's a legitimate strategy. You should do that. But if you're like me, whose job it is to allocate capital to a place that I can actually increase the value of my client's money, that's not really an option. I can do it from time to time, and we do hold cash from time to time. And sometimes I think it's very important to hold cash. But sometimes you need to use the volatility to your advantage. And I think if you're managing money professionally, you have to have an opinion. I don't think you get to just sit on the sideline forever. It's okay to sit on the sidelines for a while. It's okay to use cash to your advantage. It's okay to, if somebody allocates to you and they say, I don't want you holding cash because I didn't allocate to you to hold cash, then I think that's not necessarily the case either, because you're not just paying me to allocate capital, you're paying me to allocate it at the right time. So I'm not against sitting in cash from time to time, but I'm not going to sit in cash for the next 2 years. As an asset manager, I'm not going to sit in cash for the next 2 years. I'm going to try to find some relative good places to be. And I think that this currency crisis that's coming, and this fixed income crisis that's coming, and this pension crisis that's coming, is going to create amazing opportunities on the long side and the short side. Again, you can do a lot of this stuff on a relative basis. If you don't feel like just buying U.S. equities outright, I feel comfortable shorting European equities and using the funds from shorting the European equities to buy U.S. equities. I mean, I'll do that trade all day long because I think Europe is in much worse shape than we are. So it gets a little different if you're a long only investor, or if you're not open to doing those kinds of trades. But I find it really fascinating right now because I think everybody knows that the system itself is under pressure, and the system itself is going to have to change over the next let's just call it decade. And I think a lot of people have a very certain way that's going to play out in their mind. And I'm not certain about anything. I think you got to be very flexible. I think you got to be very open. You've got to be willing to be, you've got to have an opinion, but you've got to realize that you could be wrong and be flexible enough to change if that happens. But I also think you have to have an opinion. And I think there's going to be great opportunities over the next 2 or 3 years to make some really good money.
And from a historical standpoint, Brent,
so.
we're in uncharted waters.
If you look at
it's unprecedented what the central banks have done in the last 10 years. Rules changes.
Treasuries as an example.
Massive amounts of corporate fraud. There's accounting scandals that are going to be coming down the pipe over the next 5 or 10 years.
Right?
That in the past, 10, 15, 20 years ago, probably people would have went to prison for already. But when I look at the 10-year U.S. Treasury yield, we're at 2.85%.
It's gone down. It's probably going to go up again.
Treasury bonds have had a rally despite the Fed rate hike. So do you think that's money that's come out of the U.S. stock market then and into
you should get out
treasuries
of the market right now, because I don't think this volatility is going away. I mean, last year, 2017, I think the market only had a handful of positive 1 or more than 1 or 1% days, either up or down. And this year we've had 25 or 30% days. I mean, it's just crazy. The no volatility last year compared to the volatility this year. And I think this year is a sign of things to come, not necessarily last year as a sign of things to come. I totally understand if people, if they got burned in 2000, if they got burned again in 2008, and they just don't have the stomach to be in the market right now, I completely get it. And if you have enough cash that you can just sit on the sidelines and live off, not making a lot of money on your cash, that's fine. There's nothing that says you have to invest. I'm just saying, if you're going to invest, I think that the U.S. is a relatively better place to do it than the rest of the world.
In February,
it doesn't mean that I think that
the
the U.S. has done a good job
ETFs.
of
I think that was just like the first act.
I don't think it's the result of the U.S. Federal Reserve doing a good job of monetary policy. I just think the whole world is screwed up. I think all asset classes are bubbles, and I think it's just as likely that the fixed income bubble breaks down before the equity bubble. And on a relative basis, I think that's a place that you can be. It doesn't mean it's going to be easy. It doesn't mean the market might go down to 10 or 15, 20% from here. I can't say that won't happen. It very well might. But I think if that happens, then the central banks are going to probably come back in and do, some other thing. And it's going to put, another stimulus program, and it's going to put them in an even worse fiscal shape, which is going to make the sovereign debt bubble even bigger, which when it breaks, then I think equities ultimately go higher. So I don't think that we're going into a recession right now. It's possible. I can't take that off the table. But I think it's very possible that equities continue to move higher over the next couple of years as just on a capital flow basis. I mean, at the end of the day, nothing matters more than capital flows. If you have flow of capital, then you have liquidity. If you have liquidity, then you can operate your business. And if you can operate your business, hopefully you're operating at a profit, and prices can go higher. I kind of feel like if the Fed were to reverse course, or if the Fed were to drop rates, then I would see capital leaving the United States. I mean, if we're lowering our interest rates and, we don't have this relative advantage over the rest of the world, why would capital stay here? So, I kind of feel like as soon as the Fed blinks or turns around or reverses policy, that's going to be the signal to get the hell out, because in my mind, everybody else, all the other capital will be leaving. I don't want to be the last one sitting here holding the bag. So I kind of feel like as long as they keep the steady pressure on of raising rates, everything is fine. And then or not everything's fine, but relatively fine. And as soon as they turn around and go the other way, I kind of think all is lost. I think, your point's a good one. I mean, they've raised, 2 times this year? I can't remember. They raised 2 times or 3 times this year now. But interest rates are where they were in the spring. So, and stocks are where they were in the spring. So, if I'm Powell, I'm pretty happy. I've gotten my interest rate
or Brent, the stock market starts to slow down a lot when the $1 trillion plus per year in share buybacks that these large corporations are doing with debt, not with free cash flow. Those things drastically drop.
Again, I don't think it's going to be
the game
easy,
that's being played right now. I don't see that anytime soon. It may slow down, but I don't see it stopping.
To dissuade me from my theory yet.
So let's transition now to China. I don't know if you've seen the Real Vision television interviews that Kyle Bass has done with Chinese billionaire,
first of all, what
estranged Chinese billionaire Miles Kwok. He brought up some really controversial stuff in there. Kyle Bass also interviewed Steve Bannon. Kyle Bass has interviewed, I think, a Harvard professor on the
but it's just
what the Harvard professor says is a new Cold War between the U.S. and China. So do you think then that China has really weakened their position in the last 10 years? Because, I mean, it seems to me when I look at the amount of credit that they've created in dollar terms, like almost $50 trillion worth of credit in just 10 years, their credit is exploding. Some of the stories I've heard anecdotally about real estate bubbles in other countries and cities like Vancouver, Australia, a lot of Chinese money. So what do you think about China and what they've done over the last 10 years?
If you don't think China's done the same thing, you don't understand math, because they've done it on a scale that makes us look relatively prudent. And this is going to have negative side effects. Now, I know that there's people out there that say, yes, but that's part of a long-term plan, and they're building it all now, and so when the economy turns down, they'll still have real assets, and they might not have dollars, but they'll have real assets. And I just think it's a bunch of bull, to be honest. In the same way that a credit, you can't taper a Ponzi in the U.S., you can't taper a Ponzi in China either. Credit collapses are not pretty, whether they're in the United States, and they're not pretty in China either. China's not immune to the laws of mathematics and credit. So I think China's probably going to do very, very well over the next several decades. But over the next several years, I think they're going to have a lot of trouble. They have a lot of capital that's built up in this credit system, and it's just really hard to taper a credit bubble without some real hard days. And I think Australia is going to go through that. I think China is going to go through that. I think Europe's going to go through that, and I think we're eventually going to go through it again. But these people that tell me that China has this silver bullet that's going to allow them to, avoid the mistakes that we've made, I just shake my head.
The other argument that I hear, Brent, is from the gold community, normally bullion dealers, and also people in the alternative media, and it's that China's credit bubble doesn't matter because they owe the debt to themselves.
I talk about this a lot.
And then also China has 20,000 tons or 30,000 tons of physical gold.
First of all, I think gold's going much higher.
They have all this gold, and they can rewrite the rules, and all their credit bubble doesn't matter, and they'll just either bail out their banks or waive off the credit, forgive the loans. But I think there's a counter argument to that, and the counter argument is, number one, they've grown their credit way faster than their gold holdings. And we don't know their real gold holdings, but we know we have a general idea of how quickly their credit grows. And their credit's growing way faster than they're accumulating gold. And then number two is that the dollar denominated debt. So I think whether it's Chinese state-owned enterprises, Chinese corporations, there's a lot of dollar denominated debt in China.
To get out of under the thumb of the dollar. But at the end of the day, all these de-dollarization stories, they are desires, but they are not reality as far as operating today. Of course, they would like to use something other than the dollar. Of course, they would like to have another payment system through which they can trade with the rest of the world. Of course, they don't like being bullied by the United States. Of course, of course, of course. But just because you want these things don't mean you necessarily get them. Now, are they working to build something? Probably. But I've been hearing this building story for 5 or 10 years, and everybody keeps telling me, oh, they're going to spring it on us at a moment's notice. Well, I got to tell you, I think the rest of the world's already fed up with us enough that if they had the ability to stick it to us right now, they'd be happy to do it. A month ago, there was this big, push that the European Union was going to set up a special purpose vehicle with Iran to trade oil and to avert the U.S. sanctions. And that was going to be seen as this big de-dollarization. And, people said that the U.S. blinked, we backed down, et cetera, et cetera. Well, it turns out that not only did we not blink, but we didn't back down either. And it ended up that Europe backed down, and they are going to impose the sanctions on Iran. And, very few companies signed up to do this SPV to avoid the dollar payment system. Because at the end of the day, everybody wants to still do business with the United States. Even though they don't like us, we're one of the biggest markets. So, if they want to continue doing business with us, they can't avoid, the dollar payment system and start trading with Iran. So it's, I completely understand the eventuality of de-dollarization. I completely understand other countries wanting to get out from underneath the dollar. But listen, at the end of the day, politicians don't do anything until they absolutely have to. And right now, they don't really absolutely have to. And I don't think that there is another system in place that could supplant the dollar right now. I mean, if you've ever been in a meeting with more than 3 or 4 people, and you try to get everybody to agree on a time and a place and a strategy, it's next to impossible to get more than just a couple people to agree. So now imagine you've got to come up with the problem with de-dollarization is it only works as if everybody leaves the dollar at the same time, or the majority of trading partners leave the dollar at the same time and agree to all at the same time shun the dollar and trade with each other. So to do that, you've got to get all of these different countries and all of their competing factions and all their competing constituents to agree that they're going to leave the dollar. Then you've got to get all of them to agree which currency they're going to use other than the dollar. Then you've got to get them to agree who's going to enforce the system and who's going to host the system. Then you've got to get them to agree who's going to build the system. Now, if you think all that stuff happens just overnight, like snapping your fingers, it's just not reality. Now, again, I'm sure they're working on something like this. I'm sure they, have had discussions of how they could possibly do this. But the fact is it just doesn't exist right now. And so the idea that everybody's going to leave the dollar overnight, I just think it's wrong. I mean, that's it. At the end of the day, everybody always gets easy money. It pays dividends right away, and it's so addictive that you just do more of it than you ever should.
The other thing to add to your points there, Brent, is that people are trading in RMB, but it's not a reserve currency. So you have people who reluctantly use the RMB and then they want to dump it. I mean, if you believe the stuff that Miles Kwok is saying, the Chinese don't, the elites in China don't even want to hold RMB. They want to dump it and get rid of it. They're even willing to pay large money laundering people a 40% fee.
I tend to agree with you.
Those,
a lot of people,
counterfeit RMBs that were created out of thin air, billions of dollars into dollars or euros as quickly as possible.
And that he's kind of, he's picked a fight with China and he can't win. Well, you know what? I actually think he can win.
If half of what and when I say win, is true, I mean, China has really they were in better shape 10 years ago before they went nuts with this credit stuff. I think we have a stronger hand than China does right now because on a relative basis, our economy is stronger than theirs. Now, it doesn't, again, I'm not saying that we have an amazing hand. I just think we have a better hand than China does. And I think there's an incredible amount of political risk in China that, if they go into a credit slowdown and a growth slowdown, it's going to put a big dent in their, the public persona that they have of themselves as being on the rise. I use the poker analogy that they've overplayed their hand.
The emerging country, et cetera, et cetera. So, I mean, if people start to lose money in real estate in China, that's going to be a big political issue for the Communist Party. So, they certainly have ways to kind of extend it and cover it up and, keep the people quiet. But at the end of the day, I think the problems are just too big to sweep under the rug. No question about it. Again, I don't want to preach. Everybody's entitled to their own opinion. I would just, suggest
and
that
there's
anybody's
also,
doing analysis.
To your point there, there's also a massive amount of non-performing loans in China. So what are they going to do? There's some Austrian School economists that say China's in a better shape because they produce things, they manufacture. Well, I would disagree with them on that because I think there's a lot of evidence out there, Brent, that China has been bailing out some of these factory owners by they should have defaulted already. There was bad loans, bad debt. These factory owners should have went bust, and they've been telling the Chinese government, because they own the banks, have been telling the banks not to call in the loans. So there's like overcapacity and overproduction. That, as an Austrian School economist, to me, Brent, would still be misallocation of capital. So just because they're producing stuff or manufacturing doesn't mean it's correct allocation of resources.
Yeah, so I'm going to make a lot of people mad here again and say that I just don't think that we've seen the bottom yet for gold. Now, listen, people hate it when I say that because they say, well, how can you be a proponent of gold and say that gold hasn't found its bottom? And It's okay to own something and not expect it to pay off tomorrow. You can have a portion of your portfolio
So
that
as
you
we
don't want to sell,
transition
but
here
that you want
to
to
the
hold on
last
to pay off
segment,
5, 10, 15,
let's
20 years
talk
down the
about
road.
gold and silver miners.
I
So you do
view
like gold,
as
but
insurance.
do you make a
I own
distinction
gold
then
for
between
the counterparty
owning
risk
physical metal,
just as much
physical
as I
gold and
do
silver,
for
and then
the
also owning any
inflationary,
positions to gold and
hyperinflation
silver
risk.
companies? Because we're at
You know,
1247
I've been
gold, a little bit above
proponent
that
of gold
change,
for
and
over 10 years, probably
$14.60
12
silver.
years.
So
I've
are
been
we
owning
at
it
prices you
for
think that the
clients'
miners
portfolios.
can actually survive? Because some of these
I
mining
don't think
stocks,
people should
Brent,
sell it,
they're
but you know, I
basically
don't think it's
penny
going to pay off
stocks
right
now,
away. I
where
think
the
the
mutual
dollar's going to get a lot
funds
stronger. I think
and
that's
some
going
of
to
the
be a headwind for
ETFs even
gold
are going to have to
because I think
start
it's going to be a
dumping
headwind
shares.
for all commodities. And I think mining companies, including gold companies and silver companies, I think they're going to remain under pressure. Now, that doesn't mean they're not going to have 2 or 3 month periods where they go up 20 or 30%. I mean, that's what these things do. I mean, look at last month, the miners kind of made a low at the end of November, and now they're up, I don't know, 5, 10% in the first 10 days of, or first 7 days of December. Maybe they'll go a little bit higher in the short term, but I just think that I just don't think that the gold is going to completely break out yet. And I don't think that the dollar is going to get a lot weaker from here. And I think the dollar is going to get stronger. So I think until, you know, we've had that initial big breakout of the dollar, I'm not planning on gold having its big breakout. Now, listen, if I'm wrong, I'm wrong. And if I have to buy some of these mining companies at a higher price, then I guess I have to buy them at a higher price. But I sold my miners a couple years ago, haven't bought them back. We still own physical. We've had some hedges on our physical, which helped us a little bit earlier in the year, and it's hurt us a little bit here in the latter half of the year. But you know, I'm a big believer in gold. I'm a big believer in owning the physical stuff, and at some point, I will be a big believer in owning the miners. But you know, let me give you a good example. I was talking to somebody the other day, and they said, what would you have? What would you have to see from a price perspective on gold to really get bullish gold? And I said, well, if we went to 1350 or 1360 and actually held that and like closed the month up there, that would be a pretty hard sign to ignore. And they said, yeah, Brent, but that's 10% higher. You'd miss out on 10%. And I said, who in their right mind is owning gold for the next 10%, right? I think people are owning gold for the next 100% or 200%, and people are owning the miners because for the next 300% or 500% move that comes in the 5 to 10 years once gold initially breaks out. And I asked that same person if gold got to 1360, would they still be recommending people to buy it? And he said, yeah, absolutely. And I said, okay, so then what's wrong with me buying it at 1360 as well? So yeah, is it possible that I'll miss out on the very first leg up? Sure. But you could have made that same argument at the beginning of 2016 as well. And look what happened. You know, the miners went up 100% or something in the first 6 months of 2016, and then they gave it all back. Right. So I just don't think we're there yet. Well, that's one thing that these mining companies are extremely good at. You know, there's a very well-known guy in the gold world who I'm not going to say his name right now, but he's been incredibly nice to me and an advisor to me, and you know, kind of taught me a lot about the business. And I remember 7 or 8, 9 years ago, we were having lunch, and I said, you know, the government's just going to print the hell out of the currency, and it's going to inflate the dollar, and you know, these mining companies are going to go through the roof. And he looked at me and he kind of winked and he kind of laughed. And I said, what? And he said, yeah. He said, Brent, that's true. He said, but just remember, whatever the government can do, the private sector can do even better. And he said, if you don't think the guys in Toronto can print stock certificates, you haven't seen anything yet. So, I mean, right. And then look what's happened. Look how many secondary raisings and financings, and look at all the dilution that's taken place in the gold miners.
One of the reasons they gave it all back, Brent,
now listen,
was because
anybody that's in the gold mining
raises.
space and that's listening to this, I'm a fan, right? This is going to be a fantastic place to be. I just don't think that we've necessarily got to the point where we're at the breakaway right now. The companies have gotten better. They've slashed expenses. They're as lean as probably that they've ever been. But that doesn't necessarily mean we're going to take off right here. And if we do, then I will tip my hat to them and I will say, fantastic job. I missed the first 50% move, or I missed the first 100% move. But I think once we make that move, we're going to go up a lot more than 50% or 100%. So if I have to catch the last 600%, so be it.
I'm pretty sure I know who told you that.
I don't know if you look at charts or technicals or not. And listen, I use a little bit of everything. I don't use anything exclusively, but I like looking at charts just because there's so much information built in a chart. And one of the things that I like to look at to give me an idea of whether we're breaking out or whether we're moving in the right direction as far as a precious metals bull market is the gold to silver ratio. A lot of people look at the silver gold ratio. I actually look at gold silver. And it's at 85 right now. And if you look at that on a daily, a weekly, a monthly, a quarterly, or a yearly chart, it does not look good.
Yeah, I'm still worried about their margins.
Over the last,
so the oil prices have come down quite a bit in the last month or so.
We're at the highs.
But the metals prices did have a correction. So we're going to have to see what the next couple of quarters are for earnings reports, what the margins are. But, even when the gold price and silver price were higher, the margins were not good and the companies were not producing the free cash flow that they said.
The other way.
So they have
the close at the end of this month is going to be a weekly close, a monthly close, a quarterly close, and a yearly close, and that does not look good on the gold to silver ratio. And because I believe the dollar is going to get stronger, I just think that that kind of scares me a little bit, and it just tells me that, listen, maybe gold's going to bounce right here, maybe gold and silver are going to bounce right here, and maybe this is a great place to be long, and that's why I loan gold. I haven't sold my gold. Maybe it is a good place to be long, but I also think that it's possible that it's going to break that level and it's going to go higher. And you would expect this ratio to be coming down in a precious metals bull market, because once the precious metals bull market starts, you would expect silver to be outperforming gold, and you would expect miners to be outperforming gold and silver. And if gold is outperforming them, to me, that's not a really bullish sign. And right now, gold is outperforming them. So I need to see that turn and start making a move before I start to get bullish, at least short term in the metals. Again, I'm extremely bullish long term in the metals. I'm just not sure that it's going to pay off in the very short term. And this is the exact reason why silver will be such a fantastic investment and why it's going to go through the moon at some point, is because you're getting to the point where mines are not producing, or maybe they're shutting down. The ones that are producing are probably not producing that much. And so you're going to get into a supply demand where supply just doesn't exist. Right. And so then when demand is up, it's going to create this, hockey stick higher. And I just don't think we're there yet. That's all.
I think primary silver miners are in much worse shape than primary gold miners. If you listen to my Nolan Watson interview, he's the CEO of Sandstorm Gold from last Friday. He said the same thing. He basically said that no primary silver miner on planet Earth is making a profit at the current prices. So basically, these primary silver miners, some of them have had to buy a lot of gold mines in the last 5 years, and the only reason they're making money is on their gold mine. They're not making any money at all.
Right? I don't have the numbers in front of me.
We're going to see.
But, that's the biggest gold company in the world. I think they're bigger than Barrick at this point. Anyway, it doesn't matter. They're one of the two biggest gold companies in the world, and that wasn't exactly a quarter that says, "Hey, we're at the beginning of a gold bull market here," right? So I just, as much work as these companies have done, I just think that they maybe have some more work to do. And again, I don't want to put people off of the sector. I think it's a fantastic sector.
Yeah, we have to see on the supply side. I agree with you. We have to see those that silver byproduct from the copper and base metal miners. We have to see that be reduced, or those companies go bankrupt, and we have to see some of these primary silver miners either go bankrupt or drastically reduce supply. But we talked about this a couple minutes ago. The companies, to save themselves, the CEOs don't want to lose their jobs, so they're going to do games. There's a rally in the gold and silver mining shares. There's going to be enormous capital raises to buy time, delay bankruptcy, or they're going to do a reverse stock split.
Wow, now that's a very loaded question. You're trying to get me in trouble with a lot of friends. So let me say this: in a free market, the Austrians are absolutely correct. And their analysis, I think, is far and above the analysis done by, other schools of thought, let's call it, right? But we don't live in a free market. We live in a market where many of the players don't subscribe to Austrian economics. They subscribe to the competing theory. And we live in a world, in a market where much of the institutions and the financial intermediaries, et cetera, are all working in a system that kind of goes against Austrian economics. Now, over the long term, Austrian economics will trump it.
So last question, Brent, before I let you go. Your view on Austrian School Economics. So do you think the Austrians have gotten their analysis of what's been going on with the central banks more right than any of the other schools of economics that you studied since you've been in finance for so long?
But I think you also have to consider some of the other factors in the market that can, at least in the short term, override some fundamental market principles. So the short answer is yes, they have gotten it more right. as far as what will eventually happen. But I don't know if anybody does a better job of explaining the Austrian point of view than Peter Schiff. But he's gotten the last 7 years absolutely wrong. Now, it doesn't mean he'll be wrong for the next 7 years. And I'm not taking pot shots at Peter Schiff, because he called, 2006, 2007, 2008, he called it fantastic. But he has gotten the last 7 years wrong, because I think if we lived in a free market, then he would have been absolutely right. But there's a lot of factors that were put in place to overcome, quote unquote, the free market principles that the Austrians espouse. Well, they assume price discovery, right? But price discovery has been outlawed almost, right? When you have central banks and then they're setting the price of money, if you manipulate, first of all, setting interest rates, that's manipulation. It's just by definition, right? And if you're manipulating interest rates are nothing more than the price of money. So if you're manipulating the price of money, then that means you're manipulating everything that's priced in that money. And so if you're manipulating price, then price discovery is effectively
yes. There was a lot of Austrians like leadership talking about hyperinflation. Right? So there's an argument to be made that asset prices have gotten hyperinflated with the valuation and the everything bubble and the credit bubble, but there was not consumer price hyperinflation, which is what many Austrians were predicting. The other thing that I think threw many Austrians off for a loop was how the economic and political elites, whether it's governments in major economies or central banks in major economies, they've gotten away with all these like rules changes. So the Austrians are expecting a lot of people to be like that there's rule of law, that fraud gets prosecuted.
We all have our good days and we all have our bad days. So let's just hope we have more good than bad. Well, you can send me an email, just brent@santiagocapital.com. You can follow me on Twitter. I'm pretty active on Twitter. It's Santiago AU Fund. Mm-hmm. You can follow me there and, listen to Wall Street for Main Street. That's a great place to get this kind of knowledge. Yeah. I don't either. All right. Take care. Happy holidays and happy to come back anytime.
So, Brent, I want to thank you for your time today. I think you've given our listeners a lot to think about. They may or may not agree with a lot of the things that you've said, but I think you backed up a lot of the stuff. Plus, you've been right a lot recently. So there's that too. So if our listeners want to follow your work, how do they do so? Okay, great. And we'll have to have you on for an update probably in the next 4 to 6 months, because I agree with you. I think there's going to be a lot of volatility and a lot of fireworks. We'll have to see what this trade war, how it escalates, because Trump is saying that, we're going to have a deal soon. And honestly, I don't believe him. Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.